My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm just trying to make a little money. My job is not just to entertain, but today's like today into context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Everybody thought they could get out of the market and then jump right back in at the perfect moment once we started seeing some progress on the debt ceiling front. But when that actually happened last night, you barely got a chance. There was a very small window before stocks caught fire. Too small to put money to work, especially big money, which is precisely why we had such an amazing rally today, with the Dow gaining 409 points, S&P putting up 1.19%, NASDAQ pole vaulting 1.28%. Too many people thought they'd get an all-clear signal and then be able to buy stocks at low prices, easy as pie. How about a pie in your face? As is so often the case, the break we got in the debt ceiling, it occurred after hours. A speaker who seemed more amenable to a deal and a president who blinked and cut short his trip to East Asia. They came together to produce an era, let's say, of relatively good feelings for now. But there was no opportunity to get in because stocks immediately roared in response, as they almost always do. Of course, we're talking about Washington here. Our politicians are great at posturing, but not so great at compromising. So there's certainly a chance they'll drop the ball in some sort of televised fit of pique. Everything could easily fall apart at the last minute, with the government having to adopt some emergency method of debt payment that crushes the stock market. I know that, and you know that. But man, at least both sides agree here. There's a framework. Now, if you're using the 2011 playbook, the last time we had such a bitter debt ceiling standoff, the agreement to create a framework was what ultimately led to an actual deal back then, even as both sides were very unhappy with it. A framework meant that the bout was running its course. Two prize fighters exhausted and willing to accept the white flag rather than keep struggling. Of course, as I've been reminding you forever, in the 2011 fiasco, where the market fell 19% from peak to trough, we thought we were in the clear with the debt ceiling deal, and then we got decked by a debt downgrade from the Standard & Poor's company that pummeled the whole market. That caused, yes, fears of a recession right in our face. Could that happen again? Sure. But it's unlikely because nothing's happened this time that didn't happen a dozen years ago. Either way, it's been dawning on people all day. Unless we get some sort of setback in the talks, a real possibility, then the buying opportunity may have come and gone. Now, I bring all this up because this is a teachable moment. This whole debt ceiling exercise shows you how investing really is so hard and why it's hard. First lesson, you always have to realize where you are versus the crowd. The crowd being where you don't want to be, because when everybody's betting on the same thing, there's rarely much money to be made when you join them. And coming into this week, the crowd was extremely negative. There was more cash on the sidelines than any point since 2009. Let's think about that. What happened in 2009? That was when we got the generational market bottom, the time when you had to buy everything, because people hated stocks and the asset class looked as dead as I've ever seen it because of the Great Recession. We were worried about the fate of the republic, for heaven's sake. And maybe there'd be no banks left after they nationalized them. That was the worst part of the Great Recession. Right now, there's nothing close to that level of horrible. Yet the cash positions are equal. A crash and the same position is... no, it's unfathomable. And to think that there was less cash on the sidelines back in 2011, the last time we went through the debt ceiling nightmare, I was worried this time would be worse than 2011. But after today, it certainly seems like we're in better shape, and we're certainly better shape than 2009. Second lesson, when people get real negative, they're closed off to new ideas until their eyelids are pulled from their heads with pliers. Take Home Depot. The home improvement retailer reported what I thought was a pretty decent quarter yesterday. Not great, but it was hampered by weather and a collapse in lumber prices. All reasonable. Weather is frequently dismissed as a bogus alibi. But California, where many of their stores are, was hit with torrential rains over a sustained period of time, and those storms crushed a huge percentage of Home Depot's most important sales. Now, there were plenty of people who acted like it was the end of the world for Home Depot, and plenty of others who won't touch Home Depot because they're so worried about the residential real estate market. So the stock plummeted 6 points in yesterday's session. But students of the Great Orange know that what matters to their sales is the worth of a home. And did you know that there's been $15 trillion in increase in home values since 2019? That's incredible. Yes, this quarter and perhaps this year, people will spend more on travel and leisure than homes. We get that, right? I keep telling you that people are long on money and short on time. But houses need maintenance. They need refurbishment. Appliances go wrong. The housing center does not hold. So Home Depot sales will come back, and the stock gains 10 points. 10 points today, finishing well ahead of where it was yesterday after the so-called bad loss. In the meantime, 3% yield, great balance sheet. Put me up. Same thing happened to Target this morning. You had an upside surprise, a genuine one, but people were way too fearful until they weren't. And the stock was down big at one point. Had a nice rally. Don't worry. As we told Investing Club members at our noon club call, you can still buy the stock of TJX, which had the best quarter of the entire group. You know, that off-price sector is so good. Now, if you want to know more, just go to the replay of today's monthly club call. It's real good. Join up by opening the camera on your phone, all right, and pointing it at the QR code that's right here. You won't be disappointed unless you don't know how to use a QR code, and then you got to go to the CNBC.com website. Third lesson. We had a half a dozen billionaires come on our network and give interviews in also other venues. And this is all I'd say within the last 5 days. And all they wanted to talk about was how everything is so awful and terrible, dangerous. They're not just groaning about the debt ceiling. They ran about how stocks are overpriced and how the market's dangerous. They always hate the market, always. Well, I gotta ask, is it more dangerous now, less dangerous, or were they just wrong? Now, if you want to understand the bad advice from the billionaires issue, it's nothing new. You need to go back in history to learn about what the first super wealthy Americans thought of the stock market before TV. I went to the House of Morgan, an amazing book by one of my favorite writers, Ron Chernow, to see how the Morgans invested in the 1800s. Smart guys. It was interesting. Junius Morgan, the father of J.P. Morgan, became one of the richest men on earth with a philosophy that boils down to, it's not even worth talking about investing unless you know for certain you'll get your money back and more. He only wanted sure things, and stocks are not a sure thing. Today's billionaires aren't any different from Junius, except they have more ways to share this perspective with regular people than he did. These guys have no need to take any risk because you only need to get rich once. But unless you're super rich already, that perspective is meaningless to you. Mind my words. These people, like Junius Morgan, are not here to help you make money. They are here to tell you they don't need risk because they have lots of money already. If that's you, then fine. You certainly don't need the show. Me? I'm still trying to help like others help me. It's what I do. Finally, I want to remind people that you do not need to fret. The amazing thing about the market is that it always gives you opportunities. Heck, individual stocks like Caterpillar, gave you a chance this morning because very little of the $1.2 trillion in infrastructure spending has been given out yet. Or how about First Horizon? This bank is FHN is very familiar with viewers, all right? It's a bank that's doing fabulously. And yet its stock has lost more than half its value because a suitor was forced to drop its bid. First Horizon is so darn cheap, I buy it today. Bottom line. The answer to all these issues is hidden in plain sight, like Poe's purloined letter. Stay invested, but keep a nice chunk of cash to buy more into weakness. But if you haven't already put that cash to work at lower levels, you might want to leave some on the sidelines for the moment, wait for things to cool down, or how about buying some of the individual stocks I have said are still good, both in today's club call and just now. Keith in Wisconsin. Keith.
Hi, Jim. It's great to talk to you again.
Thank you for calling.
I think what I've got is a fairly high-class problem. My biggest portion of my biggest holding in my portfolio is a stock that you call a don't trade it, hold it, don't trade it, and it's become the biggest stock in my portfolio by far.
Right.
And it's all the house's money.
Oh, fantastic.
I've trimmed and trimmed. It's all the house's money. So my question is, given the market, do I trim some more, or do I just say it's the house's money and leave it be big?
And the stock is?
I can't tell you. Nicole wouldn't let me.
Oh, you can't tell me. Oh, no problem. Okay, well, look, if you played with the house's money, if you've made all the sales, the reason why that's been my philosophy all my life is that you never touch it again. You've won. You can't lose. It's the house's money. You let it run. Okay, this whole debt ceiling exercise shows you why investing's so hard. I say the smartest thing is stay invested, but keep a nice chunk of cash to buy more into weakness. On Mad Money tonight, we're continuing our hunt for opportunity by looking at three key sectors of the market, starting with semiconductors. We've seen the space make a strong comeback this year, but can the chips keep avoiding a dip? I'm finding out with OnSemi CEO. Then, after roaring higher last year, the defense contractors have been awful performers in 2023. Of course, thanks to the debt ceiling crisis. But with the market heading higher today on hopes of a deal, what could it mean for the sector? And I'm giving you my take on big tech stock that once again is looking down after hours, and that's the stock of Cisco. But what are its earnings really signaling? Why don't we wait and talk to the CEO fresh off the report? So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.